Over the recent weeks, global monetary policy continued to drive markets higher and support hedge fund performance. Early March, the ECB started to implement its quantitative easing program, pushing the euro sharply lower and supporting European equities. On the other side of the Atlantic, the Fed revised downward its economic projections mid-March and as a result supported risk sentiment globally as well. In this environment, hedge funds continued to post solid performances. Now they are up 3.5% year to date. Hedge funds' performances were mainly driven by CTAs, as expected, and to a lower extent by global macro and event-driven managers. On the one hand, macro conditions from the Fed and the ECB continued to support the dollar higher, commodities lower, and CTAs have been able to capture these trends on FX and commodity markets. On the event-driven side, their performances were mainly driven by the M&A frenzy in the healthcare sector. They have been able to capture this strong trend in M&A in the US in particular, and as a result, they are the strong performers over the recent period as well. In the long-short equity space, Asian managers and emerging market managers have benefited from the softer stance from the Fed, and in particular, Asia has been booming and local managers have been doing very well. On the other side of the spectrum, long-short credit, convertibles and fixed income arbitrage managers have underperformed, as expected in our recent briefs, due to the fact that the high-yield market continued to be shaky, and nevertheless, some managers are still doing well in this space, despite the fact that the overall strategy is underperforming in the hedge fund space. In the near term, macroeconomic conditions in the US will be closely assessed by the market in order to reprice monetary policy accordingly. Q1 GDP figures will be released soon, and they are expected to be lower than the Q4 2014 GDP growth figures. As a result, monetary policy in the US is likely to be adequately repriced, probably for a first rate hike in September rather than in June, and as a result, some strategies should benefit more than others in this context. In the long-short equity space, for instance, EM and Asian managers should continue to benefit from this softer stance from the Fed. In the global macro space, managers should benefit from the continued rise in European equities as a result of the dovish tone of the ECB. In the CTA space, we think that long-term managers are exposed to trend reversals in commodity and FX markets. The US dollar could move lower as a result of disappointing figures in the US, and commodities could rise as a result. Then we prefer short and mid-term CTAs to long-term CTAs in this context. Finally, event-driven managers should benefit from this positive risk sentiment environment and from the continued flurry of M&A activity in the US in particular.